On the night of October 23, 1907, a group of the most powerful bankers in New York sat locked inside a private library on Madison Avenue, unable to leave until an old man in a wing chair decided they were finished. The library belonged to John Pierpont Morgan. By that point, he had been awake for most of 2 days, moving between meetings, reading through balance sheets by lamplight, and deciding, more or less on his own judgment, which banks in America would survive the week and which would not. There was no Federal Reserve to call. There was no Treasury program built for exactly this kind of night, no emergency lending facility, no central authority with the power to flood the system with cash and stop a run before it turned into a nationwide collapse. What existed instead was Morgan, 70 years old, half-retired, feared across 2 continents, and for roughly 2 weeks in the autumn of 1907, functioning as the closest thing the United States had to a central bank. The country had gone without one for 71 years, ever since President Andrew Jackson let the Second Bank of the United States die in the 1830s. On this particular night, the cost of that absence was about to be tested harder than at any point since. If you're enjoying this story so far, don't forget to hit the like button and subscribe. Drop a comment telling me where in the world you're watching from. I love hearing from you. Morgan had played this role before, though never for quite this long or against quite this much pressure. During the Panic of 1893, when a run on the United States Treasury's gold reserves threatened to push the federal government into default, Morgan organized a private banking syndicate that sold gold directly to the Treasury in exchange for government bonds, propping up the nation's finances at a moment when Washington did not have the tools to do it alone. 8 years later, in 1901, he had orchestrated the creation of United States Steel, merging Andrew Carnegie's steel empire with several rivals into the first corporation in American history, valued at over $1 billion. By 1907, Morgan was not simply wealthy, he functioned as something close to an unelected regulator, the one man whose personal read on a bank's solvency could decide whether that bank survived the week, precisely because the government office that should have made that judgment, in any country with a functioning central bank, did not exist in the United States. The weakness that made a night like this possible had been building quietly for about a decade, and almost nobody outside of finance understood how deep it ran. National banks, chartered under federal law since the Civil War, were required to hold a fixed share of their deposits in reserve, typically around 25% in the country's largest cities, and were limited in how aggressively they could lend. Trust companies were a newer kind of institution, and a very different one. They had originally been created to manage estates and handle fiduciary work, low-risk business by nature. Over the previous 2 decades, they had expanded well beyond that original purpose, taking deposits, issuing loans, and investing directly in real estate and the stock market, all while holding reserves that often ran as low as 10 or 15%, far below what national banks were legally required to keep on hand, because trust companies were chartered by the states rather than by Washington, and because state law had not kept pace with what these institutions had actually become, they were free to pay depositors higher interest than any national bank could legally offer. The money poured in. By 1907, the trust companies of New York City held combined assets that rivaled, and by some measures exceeded, those of the city's national banks, a fact that would have sounded absurd only 10 years earlier. And critically, trust companies did not belong to the New York Clearing House, the private consortium of national banks that had functioned, imperfectly, as an informal safety net during earlier panics, pooling reserves and issuing loan certificates to member institutions under strain. If a trust company got into serious trouble, there was no built-in mechanism to catch it. It would either find help somewhere, or it would fail, and every depositor inside it would discover exactly how much protection they actually had, which was none at all. The United States had run this way, without a central bank, since 1836. For 70 years, the country's response to financial panics had depended on a patchwork of national banks, state banks, trust companies, and, when things turned serious, whichever private financier had enough personal credibility and enough cash to convince everyone else the system was not actually collapsing. In the panics of 1873, 1884, and 1893, that role had fallen to one man more often than any other. It fell to him again in 1907. The spark that lit the panic had almost nothing to do with trust companies at first. It began with an attempt to corner the stock of a single mining company. F. Augustus Heinze, a copper magnate who had made his fortune in Montana before moving east to expand into New York banking, teamed up with a Wall Street speculator named Charles W. Morse to try to seize control of United Copper Company by quietly buying up its shares. The scheme, engineered mainly by Heinz's brother Otto, relied on a classic short squeeze. If the Heinz Group already controlled most of the stock in circulation, anyone who had sold the shares short would be forced to buy them back at whatever price the group demanded in order to cover their positions. It was an old trick on Wall Street, and this particular version of it went wrong almost immediately. The Heinz brothers had badly misjudged how many shares were actually available to be squeezed, and when they tried to force the price higher in the third week of October, the scheme collapsed on itself instead. United Copper stock, which had traded above $60 a share days earlier, fell below 10 within about 48 hours. The brothers were ruined, but that was only the beginning of the damage. F. Augustus Heinze was president of the Mercantile National Bank, and Morse held interests in several other banks and trust companies around the city. Once it became known that men connected to a failed stock scheme also sat on the boards of major financial institutions, depositors did not wait around to find out how exposed those institutions actually were. They started pulling their money out immediately, and attention turned toward the man whose name carried the most weight and, it would turn out, the least protection, Charles T. Barney, president of the Knickerbocker Trust Company, the third largest trust in New York, who had done business with Morse for years. On the morning of October 22, 1907, a line of depositors formed outside the Knickerbocker Trust Company's building on Fifth Avenue and stretched around the block by midday. Barney had gone to the New York clearinghouse the day before, hoping for the kind of emergency support member banks could count on, but Knickerbocker did not belong to the clearinghouse, and Morgan, after reviewing what he could of the trust's books overnight, told the assembled bankers he did not believe the institution was worth saving. By early afternoon on the 22nd, Knickerbocker had paid out more than $8 million to depositors standing in that line and had nothing left to give the rest of them. The trust suspended payments that same day. Barney was forced out of the company within the week. Less than a month later, in the wreckage of his reputation and his fortune, he died by an apparent self-inflicted gunshot wound, one of the few individual tragedies in a crisis that was otherwise measured in institutions rather than in lives. Knickerbocker's collapse did exactly what the bankers gathered at the clearinghouse had feared it would do. It proved that a major trust company could fail, and once depositors absorbed that lesson, they stopped asking which trusts were sound and started assuming that none of them were. The following morning, a run began on the Trust Company of America, the second largest trust in the city, and once again, the man everyone turned to for an answer was Morgan. Morgan's first move was not generous, at least not yet. He needed to know whether the Trust Company of America was actually insolvent, meaning its assets were genuinely worth less than what it owed, or merely illiquid, meaning it held real value on its books but could not convert that value into cash fast enough to satisfy a room full of frightened depositors all at once. Those are two different problems, and confusing them is how ordinary panics turn into depressions. Morgan assigned the task of checking the books to a younger banker he trusted, Benjamin Strong, Jr., who worked through the night of October 23rd auditing the trust's assets by lamplight. Strong reported back before dawn that the institution was sound at its core. It had real collateral and real loans behind it. It simply needed cash to survive the next day. That distinction mattered a great deal, because it meant Morgan was not being asked to prop up a failing business. He was being asked to build a bridge, and building bridges between solvent institutions and the cash they needed was something he understood better than almost anyone alive. Strong's overnight audit turned out to matter well beyond that one night. 6 years later, when the Federal Reserve System was created specifically so that no private citizen would ever again have to perform this function alone, Strong became the first governor of the Federal Reserve Bank of New York, the most influential post in the entire new system. With Strong's assessment in hand, Morgan set out to organize a rescue the only way he knew how, by gathering the people with money into one room and refusing to let them leave until they had committed some of it. Over the following days, the presidents of New York's major banks and trust companies were summoned to Morgan's private library at 36th Street and Madison Avenue, a building that housed one of the finest private collections of art and manuscripts in the country. Morgan worked out of a room lined with Renaissance paintings and illuminated medieval texts, and it was there, night after night, that he assembled competing bankers around a single table and pressed them to pledge money toward a rescue pool for institutions they had every commercial reason to let fail. He worked the two groups separately at first, national bank presidents in one room and trust company presidents in another, before bringing them together once each side understood what the other was being asked to give. By some accounts, Morgan passed the tensest stretches of these negotiations playing solitaire alone in a side room, occasionally sending word through an associate that no one in the main room was permitted to leave until an agreement had been reached. It was a strange kind of authority, built on nothing more official than reputation, 4 decades of relationships, and the plain fact that if the system collapsed, everyone at that table stood to lose more than whatever they were being asked to contribute. The trust company presidents eventually pledged $10 million toward a fund to support institutions under the worst strain. It was not enough to end the panic on its own, but it kept the Trust Company of America solvent through the next trading day, buying time for the moves still to come. Morgan was not working entirely alone in the wider sense either. Treasury Secretary George Cortelyou traveled up from Washington and, in a use of federal authority that was unusual for the time, deposited $25 million of government funds directly into New York's national banks, hoping the added liquidity would work its way through the system and calm depositors elsewhere. It was one of the earliest instances of the federal government stepping in directly to stabilize private banks, decades before anything resembling deposit insurance existed. Rockefeller, then the wealthiest man in the country and no natural ally of Morgan's after years of business rivalry between them, publicly pledged $10 million toward the rescue and let reporters know he was prepared to put up a much larger share of his personal fortune if the crisis demanded it. It was a striking moment of cooperation between two men who had spent most of their careers trying to outmaneuver each other, and it told the wider public that the country's wealthiest citizens, not its government, were the ones actually standing behind the banking system that week. The panic reached its most dangerous point on October 24, 1907, when Ransom Thomas, president of the New York Stock Exchange, walked into Morgan's office and told him the exchange would have to close early because member brokerage firms could no longer secure the short-term loans, known on the floor as call loans, that kept daily trading running. If the exchange shut down in the middle of a session, the shock could have triggered a far larger collapse than anything the trust companies had caused up to that point. Morgan told Thomas the exchange needed to stay open until its regular closing time, no matter what it cost. He then summoned the presidents of the city's leading banks to his office, and in a meeting that lasted a little over 15 minutes, extracted pledges totaling $25 million for emergency call loans to brokers on the floor. The money reached the exchange within minutes of the pledge being finalized. Call loan rates, which had spiked to well over 100% on an annualized basis earlier that week, came back down almost as fast as they had risen, and the exchange closed on schedule that afternoon without a single member firm defaulting. Word of what had happened spread through the financial district almost immediately, and for the first time in nearly a week, the sense of panic began to loosen its grip, even if only slightly. Even the city of New York was not immune. With credit markets frozen and its usual short-term borrowing options unavailable, the city government told Morgan it might not be able to meet payroll or cover its outstanding obligations before the end of the year. Morgan arranged for a banking syndicate to purchase $30 million in city bonds, effectively lending New York City the money it needed to keep functioning, a role that under almost any other circumstance would have belonged to a central bank or a federal lending authority, neither of which the country had. The panic did not stay confined to Wall Street. As news of the runs on Knickerbocker and the Trust Company of America spread by telegraph, depositors in other cities grew nervous about their own banks, and runs broke out in Pittsburgh, Chicago, Providence, and dozens of smaller cities across the country over the following weeks. Many local banks, cut off from New York's cash reserves and unable to convert their own assets into currency fast enough, resorted to issuing clearinghouse certificates, informal script that functioned as a stand-in for cash within a local banking system but held no value outside it. In some towns, ordinary depositors were paid a portion of their savings in these certificates instead of actual currency for weeks at a time. The broader economy absorbed the shock as well. Industrial production fell sharply through the winter of 1907 into 1908, and unemployment climbed as credit tightened, and businesses that depended on short-term loans found themselves unable to secure them. The recession that followed was sharp, though comparatively brief by the standards of later downturns, in part because the worst of the banking panic itself had been contained within about 3 weeks, rather than dragging on for months. The panic also reshaped how ordinary Americans thought about where to keep their savings. Congress created the postal savings system in 1910, allowing depositors to place money directly with local post offices, rather than trusting it to a bank or trust company that might collapse without warning. It was a modest program by later standards, but it reflected the same underlying anxiety that had driven runs across the country in 1907, a public that no longer assumed its money was safe simply because an institution said so. By the last week of October, the immediate danger had cooled just enough for the country to exhale, but the crisis was not finished. One more piece of it still had to be diffused, and it involved a mining company in Tennessee, a brokerage firm on the edge of failure, and an overnight train to Washington to see a president who had spent much of his career trying to break up companies exactly like the one Morgan was about to build. If you're hooked on this story, make sure to subscribe and turn on notifications so you never miss an upload. Your support means everything and helps me bring you more emotional stories like this one. Moore and Schlee was one of Wall Street's more respected brokerage houses, but by the first days of November 1907, it was close to failing because a large share of the loans keeping it running were backed by stock in the Tennessee Coal, Iron, and Railroad Company, a stock whose value had become deeply uncertain amid the broader panic. If Moore and Schlee collapsed, its creditors would likely dump enormous quantities of that stock onto an already frightened market all at once, risking a fresh round of the very crisis that appeared to be settling down. Morgan's solution was bold even by his own standards. He proposed that United States Steel, the conglomerate he had personally helped assemble 6 years earlier out of Carnegie Steel and several smaller producers, acquire Tennessee Coal, Iron, and Railroad outright. U.S. Steel would issue its own bonds in exchange for the stock. Moore and Schlee's creditors would receive something far more stable than a collapsing mining company's shares, and the immediate threat to the brokerage would disappear. There was one obstacle standing in the way. U.S. Steel already controlled roughly 60% of the American steel market, and absorbing one of its few remaining major competitors raised an obvious question under the Sherman Antitrust Act, the same law that President Theodore Roosevelt had built much of his political identity around enforcing. Two U.S. Steel executives, Henry Clay Frick and Elbert Gary, took an overnight train to Washington and met with Roosevelt at the White House before markets opened on the morning of November 4th. Roosevelt weighed the risk of approving one more large merger against the risk of a fresh financial collapse days after the country had barely stabilized, and told the two men he would not stand in the way of the acquisition. It was an extraordinary concession from a president who had spent years pursuing antitrust cases against companies of exactly this size, and it effectively brought the panic to a close. Moore and Schlee survived. The stock market, which had been bracing for another shock that morning, rallied instead on the news. Within days, the runs on the trust companies had stopped, deposits stabilized, and the acute crisis that had gripped the country for roughly 3 weeks came to an end. The panic of 1907 had been contained, but it left behind an uncomfortable realization that spread quickly through Washington. The financial survival of the entire country had ultimately rested on the judgment and the personal fortune of one 70-year-old private citizen, operating out of his own library with no formal authority beyond the trust other bankers placed in him. Morgan had gotten it right. He had correctly identified which institutions were sound and which were not, coordinated a rescue across dozens of competing banks, and done it all without a single piece of federal machinery built for the purpose. But depending on that kind of judgment being available, and correct, the next time a panic hit was not something most members of Congress were willing to accept as a lasting arrangement. If Morgan had misjudged the trust company of America's solvency, or if he had simply been unavailable, ill, or unwilling to intervene, there was no institutional backup at all, and everyone in Washington understood exactly how close the country had come to finding that out the hard way. The press did not miss the irony of the moment. Newspapers across the country ran cartoons and editorials marveling, and in some cases bristling, at the idea that the fate of the national economy rested with a private citizen operating out of his own library, rather than with any branch of the federal government. Some commentators treated Morgan as a hero, the one man capable of doing what no government agency could. Others found the entire spectacle unsettling, a reminder that the country's financial security depended on the temperament and health of a single 70-year-old man, who answered to no electorate and held no office. Progressive lawmakers seized on this discomfort. If a rescue on this scale could only be organized by one of the wealthiest private citizens in the country, working through personal relationships with a handful of other wealthy men, then the American financial system was not really a system at all. It was a favor extended at the discretion of whoever happened to hold enough capital and enough credibility at the moment a crisis struck, and favors of that size were not something a democracy could responsibly depend on indefinitely. Congress moved with unusual speed. In May of 1908, it passed the Aldrich-Vreeland Act, which created an emergency mechanism allowing national banks to issue additional currency backed by a wider range of securities during a crisis. A stopgap measure meant to prevent the kind of liquidity freeze that had nearly shut down the New York Stock Exchange. More importantly, the same act created the National Monetary Commission, chaired by Senator Nelson Aldrich of Rhode Island, and charged with answering a much larger question: whether the United States needed an actual central bank, something the country had not had since Jackson allowed the Second Bank's charter to lapse in 1836. Over the following 2 years, the Commission studied the central banking systems of Europe in detail, sending Aldrich and a team of economists across the continent to examine how the Bank of England, the Reichsbank in Germany, and the Bank of France managed currency, credit, and liquidity in ways the American system had never been built to do. In November of 1910, Aldrich convened a secret meeting at the Jekyll Island Club, a private hunting retreat off the coast of Georgia, bringing together a small group that included Paul Warburg of Kuhn, Loeb and Company, Frank Vanderlip of National City Bank, and Henry Davison, one of Morgan's own partners at J.P. Morgan and Company. The men traveled separately, reportedly using only first names among themselves and carrying duck hunting equipment as cover for a trip that had nothing to do with hunting, in order to keep word from spreading that a small group of the country's most powerful bankers was quietly drafting the blueprint for a national reserve system on a private island. What came out of that meeting became the foundation for what Congress would eventually pass as the Federal Reserve Act, although the version that reached President Woodrow Wilson's desk had been substantially reshaped by lawmakers wary of concentrating too much power in the hands of Wall Street bankers. Congress went further than simply building new institutions. In 1912, the House Committee on Banking and Currency, chaired by Congressman Arsen Pujo, opened an investigation into what critics had started calling the money trust, the concentration of credit and corporate control in the hands of a small number of New York banks and trust companies, with Morgan's firm at the center of the arrangement. Morgan himself was called to testify in December of 1912, 75 years old by then and in declining health, and spent hours answering questions from the committee's lead counsel, Samuel Untermeyer, about how credit actually got extended on Wall Street. Asked whether commercial credit rested primarily on money or on property, Morgan answered that it rested on character first, telling the committee that a man he did not trust could not get credit from him on all the bonds in Christendom. The exchange became one of the most quoted moments in American financial history, and it captured exactly the problem Congress was trying to solve. An economy where credit at that scale depended on the personal judgment of one aging financier, however sound that judgment had proven to be in 1907, was not a system that could be explained, audited, or replaced. The Pujo Committee's final report, issued in early 1913, argued that a small number of financiers effectively controlled the flow of credit across much of American industry, and it added considerable political weight to the case Wilson and Glass were already making for a public reserve system. When Aldrich's plan became public in 1911, it ran into fierce resistance from progressive Democrats and from populist figures like William Jennings Bryan, who distrusted a system so closely associated with a small circle of Wall Street bankers and worried it would concentrate financial power in New York rather than distribute it across the country. After Woodrow Wilson won the presidency in 1912, the plan was substantially reworked in the House of Representatives under Congressman Carter Glass, who redesigned Aldrich's single central bank into a system of 12 regional reserve banks, each with its own board, tied together under a central board of governors in Washington, appointed by the president, rather than controlled directly by private bankers. The compromise took the private banking expertise behind Aldrich's original plan and wrapped it inside a structure of public accountability, an attempt to answer the exact objection that had killed the Second Bank of the United States 80 years earlier, that too much financial power was being handed to men nobody had elected. On December 23, 1913, Wilson signed the Federal Reserve Act into law, creating the system of 12 regional reserve banks overseen by a central board in Washington, built explicitly to do what Morgan had done from his private library 6 years earlier, except permanently, publicly, and without depending on the judgment of any single citizen. Benjamin Strong, the young banker who had spent the night of October 23, 1907, auditing the Trust Company of America's books by lamplight, became the first governor of the Federal Reserve Bank of New York, the most influential post in the entire new system. It closed a loop that had opened 6 years earlier in Morgan's library. The same year that gave the country its first permanent central bank also gave it its first permanent income tax, ratified that February through the 16th Amendment. 1913 was the year the federal government finally built the two institutions it had spent more than a century trying to avoid: a bank powerful enough to manage a national currency, and a tax powerful enough to fund a national government without leaning on tariffs and land sales. Both had been resisted for generations on similar grounds: a deep discomfort with concentrated power, whether it sat in Washington or in a private library on Madison Avenue. And both, in the end, were built because the alternative, tested most dramatically in the autumn of 1907, had simply stopped being something the country could count on. What is easy to lose in the story of 1907 is how strange the arrangement actually was, even by the standards of its own era. A country with a growing industrial economy, an expanding population, and financial interests reaching across the globe had, for roughly 3 weeks, placed its entire banking system in the hands of one man's private judgment, exercised from a room filled with paintings and manuscripts rather than any government building. Morgan never held public office. He was never elected to anything. He had the reputation, the resources, and the willingness to act, and in 1907, that turned out to be the only thing standing between the country and a collapse far larger than the one it actually experienced. No later American financier, however wealthy or well-connected, was ever again asked to shoulder that particular burden entirely alone. It is worth remembering that no comparable arrangement has been necessary since. When the financial system nearly collapsed again in 2008, almost exactly a century after Morgan's library sat full of exhausted bankers, the response came from the Federal Reserve, the Treasury Department, and Congress, not from a single financier's personal fortune, whatever else might be said about how well that response worked. The institutions built in the wake of 1907 did not eliminate financial crises. They simply made sure the response to the next one would not depend on finding another Morgan. Thank you so much for watching until the end. If you loved this story, check out the other videos on your screen now. I think you'll really enjoy them. And don't forget to subscribe if you haven't already. See you in the next story.